I think it's also interesting that if you look at the left hand side of your Microsoft Windows button here, the left side would have something about the weather. If you click that or you hover on top of it, you can see markets. There's a panel here of several markets that maybe you'd want to invest in, like for example the PSEI index, FTSE 100, Nikkei, all these things. And right now they're all color red or color pink because the values of the shares are not positive, they're all negative. So that means that there are people selling selling their shares. And it's also quite interesting that when someone is selling a lot, he can really move the index, for example, the PSEI, to a low level. So if you're thinking that maybe you should sell when the color is green, which means that it's at a positive, you also might want to recall that there's a timing, um, which basically means that if you are selling and the cutoff, for example, you've passed the cutoff, it's gonna be implemented, or the changes would take effect the following day. And if the value of the shares the following day is already different, or really dramatically different from what you have today, then the value is not going to be what you'd expect, right? So there's also that factor. And I think that there are many people who may not know that, because they only see that if it's high, very high, the value is high, then you sell it, then you get high returns. But also the timing is definitely important. So in Japan, for example, what they do is they hold, they don't sell, um, in a way that is very kind of like what you'd find in the US stock exchange, where there's so much activity. Because if you are able to hold the value of the shares for a consistent time frame, then people who are really in need of the money, for example, could benefit from it. Because if it's erratic, then people won't know when to sell, or how to really earn from their investments, right? Because like I said a while ago, there's a timing factor. So if it's too erratic, how would you know that you're gonna make money? So maybe in the end, you're just gonna sell your shares and not really earn anything. It's just gonna be pretty much the same value that you bought it. And because of that, you begin to wonder what's the point of having invested in the PSEI index, for example, and only getting the same value, if not less. You could have invested it in something else, so that you could have gained the 3%, right? At least 3%, you get something out of it. Because in my case, I've seen that the value doesn't really go up as much. Although there was a time when the PSEI was going up, and maybe you could have sold your shares, and maybe you've gotten maybe 1,000 pesos or something for a certain amount. Maybe only a few shares. You're gonna sell only a few shares just to try it out or something. But of course, again, there is this factor about the timing, right? You think that maybe it's gonna go up some more, so you don't sell. Or really the case where I said that maybe other people actually were also thinking about what you want to do, and they were ahead of you. So they sold their stocks a lot faster, which made the value of the shares go lower when you when it was your turn to sell. So um, if the value, the shares are consistently going up, then I think that's a lot more predictable. But of course, if it's a lot more predictable, the risk is lower and the reward is also lower. That's why in Japan, what they're going for is really to invest abroad, to invest in the S&P, for example, and they're looking for ways to make money out of that. Although, as we can learn from Mr. Yoshiki Okamoto, there are times when he doesn't make money, loses a lot of money, in fact. Of course, because these are shares, as long as you don't sell your shares, there is still hope that it will go up. The values would go up, except that the factor in this case really would be the time that you can wait for the values to go up again. Although Mr. Yoshiki Okamoto also explains that there's really a cycle, like a wave that you can anticipate that the values would go up again, except that sometimes you don't have time to wait for that. Even though there are people who would say that it's a lot shorter, definitely, than 5 years. Because what's the point of doing this when you can have a lot more security by investing it for a period of 5 years and get maybe 4% or something like that. But usually the people who invest in very active or the kind of stock market that we see in the New York Stock Exchange or something like that, these are people who are really going for making a lot of money in a short amount of time. Yet we also know that uh, the risk is much higher, and so a lot of them also lose money. And so the point is really, I think, as Mr. Yoshiko Okamoto says, is to not put everything in, for example, in the stock exchange. You should have some portion that is cash, some portion that is real estate, some portion that is gold even. So that when one doesn't perform very well, you have other for example, cash or other sources for your daily living. And then just what he's doing, if a, a share isn't doing so well, but he believes that it will still continue to improve later on, and the value right now is low, then he'll just continue on buying the shares because it's low, and he expects that within 10 years it could double or even more in value. Okay, so I think that should be enough.